Welcome back to Money Talks. Today, I am joined by my partner, Abhishake Mathur. One of the most common questions we receive from investors is, which mutual fund should I invest in? But whenever a client asks you that question, you rarely start by talking about fund names. Instead, you stop them and take the discussions into a completely different direction. Why?
Exactly, Jaideep. The instinct to ask which fund is the best is like putting the cart before the horse. Before we can talk about funds, we have to start with the asset allocation.
So, before we even discuss a single mutual fund, you are saying we first need to decide how much should go into equity and how much should go into debt. Why is that decision so important?
Because for a single rupees invested, we must decide on how much of the wealth should be in risky growth assets like equity and how much should be in defensive assets like debt. Equity, as you know, it captures growth. It helps to beat inflation. But debt is where, whether it is liquid funds or gilt fund or bonds, it is really your anchor. It provides stability of returns and reduces volatility. So if you get this ratio wrong, it doesn't matter how great your fund selection is. If you're too aggressive, for example, you'll panic and sell at the bottom. And we have to design this wealth architecture based on your life goals before really reading anything in the fact sheet or deciding on the fund. So our first question after we assess the risk profile is to check what is the investment horizon for which the portfolio is being created.
Once we have decided the right asset allocation, investors naturally ask the next question. Okay, now how do I actually build the equity portfolio? Where do you begin?
So, the fund you select to invest needs to follow an investment strategy, a strategy that targets what I would say is the return pool. Now, what are return pools? Return pools are water holes where there's an expectation of returns consistently. These are strategies that are founded by research and backed by risk and rationale. In equity, one of the most noted study is the Pharma French three factor model. Later on got expanded to five factor, and the model suggests that strategies that specifically targets returns by investing in smaller firms, well-priced stocks, and companies that spend on expansion frugally, they do better. Now, other studies suggest that factors like momentum, quality, value, growth, they also have an impact. So many factors are a compensation of risk that you're taking, and it is also based on the biases which exist in the markets. And remember that not all the factors or these strategies can work consistently across all market conditions. So now similarly in debt investing, there can be an accrual strategy or a duration strategy, which is more to do with where you see the interest rates, or what is the end use of the funds that you're investing at that point of time, whether you need income out of it or you want to grow them. Now, simply speaking, before selecting the funds, we have to select a consistent investment strategy.
Most investors think choosing between large cap, mid cap, and small cap funds is simply about taking more or less risk. But your explanation goes much deeper than that. Can you explain how you look at the market cap spectrum while constructing a portfolio?
So we start with just the market returns, and the large cap can be the bedrock for this pool. They provide stability and liquidity. Large cap gets you invested in businesses that have got well-known history. Nifty 100 that represents the large cap covers almost 65% market cap of the entire market. Now, it may not give the best return, but provide that stability that is needed in a portfolio. But if you just stop there, you are really missing on the size premium. Pharma French identified that smaller companies, that is your mid-size companies or small cap companies, historically carry business risk, and that the market compensates this by delivering higher returns in in these companies. So by spanning the size spectrum, you are just not you are not only are betting on companies, you are capturing structural market factors, and we layer these smaller, more agile firms to act as growth engine. And if you ignore this spectrum and stick only to the giants, you're essentially capping your portfolio's potential to harvest the size premium and really limiting the upside that is there. But if you go overboard in a portfolio with only small and mid cap, well, they can have another kind of an impact, because during downturns, these companies can erode your value very quickly. So we need to have a good layer of large, mid, and small cap when you're creating a mutual fund portfolio.
Yeah, we have now understood why diversification across market cap is important. But investors also hear terms like value investing, growth investing, quality investing. Do they need separate mutual funds for each of these investment styles?
That's right, Jaideep. So, value, growth, quality, they have been much talked about factors. But mutual fund investing really makes it simple. Value and growth are fundamentally core to how a high quality active manager would select stocks. They're consistently looking at book to market ratios, profitability, quality of earnings. And if you have selected the right active manager, then he's already doing that heavy lifting for you. So you really don't need to buy a separate strategy like a value, contra. It may unnecessarily even kind of complicate your portfolio, or even dilute the earnings.
If the core portfolio is doing the heavy lifting, where do the thematic funds, gold and international funds fit? Are these essential part of every portfolio, or should investors look at them differently?
Right. How could we forget the satellite portfolio? So those are your satellite plays. Think of them as a spice in your meal. You don't need to eat the entire bowl. Just a little bit of sprinkling is good enough. So thematics are really sectoral funds or theme-based funds that can boost your performance when the cycle is in your favor, but they also carry a high non-systematic risk. Similarly, then there are diversifiers, which are like, for example, foreign funds or gold. They can act as shock absorbers, and they have low correlation to equity markets, the Indian equity markets, and they are not there to beat the market in some ways, but they are there to protect you from extreme mood swings. So, for example, last 2 years, when markets have really consolidated, gold and energy basket has given that support. So the satellite portfolio is an extremely important part, a smaller part, but extremely important part of your portfolio.
Many investors buy a sector fund or a thematic fund and simply forget about it for years. Is that a mistake?
Yeah, that's the danger. The satellite portfolios require strict monitoring. You have to be ready to exit when the cycle turns. Unlike the core portfolio, a satellite portfolio needs active, watchful eyes. They are difficult to predict and can have long cycle of underperformance. And we therefore recommend to cap the exposure to the tune of 10 to 15%.
One final question, Abhishek. Suppose an investor has built a well-diversified core and satellite portfolio. Can they simply leave it alone, or does it require periodic maintenance?
Not quite. It needs disciplined rebalancing. No single strategy works all the time. Market shift and asset factors, inevitably they return to the mean. And if a segment has really lagged for years, it is quite often setting up for a comeback. So our job as advisors is to actively rebalance the portfolios, trimming exposures to assets that have outrun their targets, and shifting capital into areas which are likely to return back.
So, if I were to summarize today's discussion, successful investing is not about finding the perfect mutual fund. It is about building the right asset allocation, constructing a diversified core portfolio, using satellite investment carefully, and then having the discipline to rebalance over time. I think that is a powerful framework for every long-term investor. Abhishek, thank you for sharing these insights.
My pleasure, Jaideep.